Hello and very warm welcome to the sessions on Indian economy. So we were discussing the concepts related to GDP in the last class, and we have discussed few concepts related to GDP. Now we will move ahead with discussing another concepts, additional concepts that are required. For example, today we will be talking about the concept of base year. In the calculation of GDP, the concept of base year we will be discussing, right? Why base year is required and what are the concepts associated with it. So to understand base year and its importance, let's make a table, right? I will present a table in front of you, and with the help of that table, we will be trying to understand few concepts associated with it. For example, what do we mean by GDP? When we are calculating GDP, we are mainly focusing on what? I hope you can remember the definition of GDP that we have written, right? The total value of final goods and services that is being produced in a domestic territory of an economy over a period of a financial year, right? So we are basically concerned with the production that is taking place in an economy, right? The production that is taking place in an economy. Now, let us assume that there are 2 years. For example, this is 2011. There are only two commodities that are being produced in an economy. So this is commodities. So let us assume there are only two commodities that are being produced in an economy, commodity X and commodity Y, right? Commodity X and commodity Y. Now, let's understand that in a year 2011, there are prices of these commodities and there are different quantity in which they are being produced, right? So since it is an older year, we are taking prices as P0 and we are taking quantities as Q0, right? And let us assume that in the year 2025, there are different prices for these commodities. So prices we assume as P1, and there are different quantities that in which they are being produced. So we consider different quantity. Let's call it Q1, right? Let's call it Q1. So this is the table. I hope we understand the headings that are there in table, right? Now, suppose the quantity is 10, 10. We are keeping simple values so that we can understand concepts better and we don't involve in the calculation part much. Quantity also, suppose it is 10 and 10, right? Now, prices, suppose in year 24, 25 or 25, the prices are 20 and 20. And the quantity has also increased to 20 and, right? Now, when we are calculating GDP, suppose we are calculating GDP of year 2011, right? GDP of the year 2011. We have kept it simple. Otherwise, financial year we write like 2011, 12, 25, 26, right? Like this we write because it starts from 1st of April and ends on 31st of March. But to keep it simple, we are writing GDP of the year 2011, right? Now, when we are calculating GDP of 2011, what do we mean by GDP? Total value of final goods and services that are being produced. So for X, what are the values of product X? 10 rupees into 10, 100 rupees means price into quantity only, right? So for X, or since we are calculating for 2011, it is P0, Q0, right? Now, for X, it is price is 10, quantity is 10. For Y also, price is 10, quantity is 10. So this is 100 plus 100. This becomes 200, right? So GDP for the year 2011 we have calculated and it comes out to be 200, right? So this is the simple calculation. Price into quantity we have calculated, right? Now we are calculating GDP for the year 2025, right? GDP for the year 2025. When we calculate, this is again price into quantity, right? product X and Y. These are the only products that are being produced in an economy. Price is 20 for X, quantity is also 20. Again, for Y, price is 20, quantity is 20. This is 400 plus 400. This comes out to be 800. So GDP for the year 2025 is 800. Now, what is the difference that we can see here? From 200 to 800, GDP has increased how many times? 4 times. 4 times. Whereas, if you realize or try analyzing table, you can see that the production, we are talking about production, right? So, quantity is our focus. We are focused on quantity. So, as you can see, when you compare quantity or the production is doubled by 2, or sorry, the production has increased by 2, or production has doubled. So as you can see, production has doubled from 1010, the quantity is 2020. Whereas when we analyze GDP, it has increased 4 times. The reason being here, for this tremendous increase of GDP is the increase of prices, because with the quantity, increase in quantity, we are able to witness increase in price as well. This is increase in price that we can witness here. So, to remove the impact of increase in price, to eliminate the impact of increase in price, what do we do here? So, we do one thing, that we keep prices constant. So, let's keep this prices constant. Let's keep these prices constant. That means when I am calculating GDP for 2025, I will be taking quantity of 2025 and prices of 2011. Right? Why I am doing this? Because I am interested in increase in production, not in the prices of, not in the increase in prices of those commodities. So what will I do here when I am calculating GDP? Now I am calculating GDP for the year 2025 with some base year, right? This, when we are keeping prices constant, this year becomes what? Base year. So what will be the GDP here now? Price into quantity, but price will be P0 and quantity will be Q1. Price will be P0 and quantity will be Q1. So as you can see here, this GDP will be 10 into 20 plus 10 into 20, right? This price into this quantity, this price into this quantity, right? So it will be 200 plus 200, that is 400. 200 plus 200, that is 400, right? So as you can see here, now if you will compare, this GDP is 200, this GDP is 400. So what has happened? Now GDP has increased. Now the GDP has doubled as compared to 2011. So what we have understood here in this calculation, that if we are calculating the price, we are calculating GDP and we are taking into consideration price and quantity of the same year, then there is impact of change in price. There is impact of change in price, right? And if inflation is there, we will encounter inflation, right? So our job here is to fix prices, right? Is to fix prices. When we fix prices to some year, that reference year will be known as what? Base year. So in this particular case, this 2011 becomes the base year. So base year with which we fix prices. Base year, right? Now, why are we using base year? We are using base year to eliminate the impact of inflation. To eliminate the impact of inflation. Right? Now there are different terms for the GDP. When you are using base year and keeping prices constant, this GDP will be known as GDP at constant prices. GDP at constant prices. When we are not keeping prices constant, this GDP, for example, here, this GDP and this GDP, these are known as GDP at current prices. GDP at current prices. So GDP at constant prices and GDP at current prices. There is one more term for it. GDP at constant prices is also known as nominal GDP. Also known as nominal GDP. Whereas GDP at constant prices is also known as real GDP, which only talks about increase in production and which is not talking about increase in inflation. So inflation impact is not there. So this is real GDP, which only talks about increase in quantity, right? Increase in production, and not about increase in inflation, or the impact of inflation is eliminated by calculating what? Real GDP. I hope we are able to understand this now. Once we have understood this, GDP at current prices, constant prices, base year, etc., there is one more term now that we need to understand. I hope these terms are clear. GDP at current prices, GDP at constant prices, nominal GDP, real GDP. Real GDP will be eliminating the impact of inflation because real GDP takes base year into consideration and keep prices constant and focuses only on increase in production. Right? So this is the idea of real GDP and nominal GDP. Now few more things we have to understand here. There is a term GDP deflator. GDP deflator. Now GDP deflator is nothing but the ratio of nominal GDP divided by real GDP. So the ratio of nominal GDP and real GDP is known as what? GDP deflator. This is GDP deflator. Now, this GDP deflator is one of the measure of inflation. One of the measure. You can measure inflation by GDP deflator also. Measure of inflation. But we have to be very cautious here. This is the measure of inflation, that is fine. But when we talk about inflation or the commodities that user consumes, or the households in the economy, or the consumer that consumes any particular goods or service, when we talk about GDP, it only includes domestically produced commodities. It only measure, or it includes only domestically produced commodities. Domestically produced commodities. But in economy, we are not only using domestically produced commodities. We are also using imported commodities, right? But GDP deflator does not take into consideration, right? GDP deflator does not take into consideration what? Imported commodities. So imported commodities are not taken into consideration. Imported commodities are not taken into consideration. So we can cancel it out like this, so that we remember that imported commodities are not part of calculation of GDP deflator. So GDP deflator will also give you an idea about what is the inflation in the economy, right? But GDP deflator excludes imported commodities. Whereas if we talk about other indices of inflation like consumer price index, wholesale price index, they takes into consideration the imported goods as well, right? So that is one difference that we need to remember, that imported commodities are not considered by GDP deflator, whereas imported commodities are taken into consideration by CPI and WPI calculation, which we will study under the module of inflation, right? So no need to worry about. This is GDP deflator. Now one more thing, if we talk about base year, then how will we choose base year? Now base year should be a normal year. Normal year with respect to economy. With respect to economy. Right? So in 2015, we revised our base year. In 2015, we revised our base year to 2011-12. Base year 2011-12. Normally, we revise base year after every 6-7 months, right? Normally, we revise our base year after 6-7 months. But as you can see, 2017, the implementation of GST was there. GST implementation. 2018, we saw this demonetization. Right? 2018, we saw demonetization. Then 2020, we saw this COVID, right? COVID lockdown, etc. So this things we also witnessed. So normal year hardly we witnessed, right? For example, then after COVID lockdown in 22, etc., we saw this globally situation was not very conducive. For example, we saw this various wars, conflicts, etc. Wars, conflicts. So normal year for economy, we have not seen much, right? That is why the revision of base year was pending. Now this 26 member committees, 26 members committee, that is under Biswanath Golder, under Biswanath Golder, 26 members committee under Biswanath Golder, was formed, and now they have given the task to, they had given the task to revise base year, right, for GDP calculation, revise base year for GDP calculation, and now they have proposed 22-23 as a base year, 22-23 as a base year. Now this 22-23 will be implemented from February 2026. February 2026 onwards, the calculation of base year will be taken into consideration according to base year of 22-23, right? So this is about base year, how base year plays a very important role in the calculation of GDP, right? One more thing we need to understand here, the GDP basically that we read in the newspaper, GDP data, mostly we talk about real GDP. Mostly we talk about real GDP. So real GDP is mostly it is being talked about, and nominal GDP also sometimes being mentioned in the newspapers, etc. But more focus on real GDP, right? More focus is on real GDP. I hope this is fine, right? So this is what base year calculation that we wanted to understand. What is base year? How base year is being taken into consideration? What is its impact, right? So this is what base year is. Now, one more thing, one more concept we need to understand here. These are the two variants that we have understood. GDP at constant prices, GDP at constant prices, that is real GDP. GDP at current prices, that is nominal GDP. Now, one more concept we need to understand here is about net indirect tax. Net direct tax, also written as NIT. Now, what do we mean by this? And this concept will give us understanding of factor cost and market price. So, factor cost and market Let us understand this. When we say factor cost, what do we mean by this? The cost which is incurred during process of production. So production has taken place, and during production we have employed, for example, land, labor, right? Capital, land, labor, capital, entrepreneurship, etc. These things we have incorporated. So there is a cost of it. So when we produce a particular commodity, then production takes place at factor cost. Production takes place at factor, so it is taking place at factor cost, right? Now, when it is being sold in the market, the prices gets altered by two things. Number one, prices gets altered by two things. Number one, taxes, or we will talk about indirect tax, and it will also be distorted by subsidies. Now, what are indirect taxes? Uh, Although we will discuss this in later phase, but as of now, you can understand that the tax that you cannot shift burden of it. For example, my income tax, right? So suppose if I come in income tax bracket and I have to pay certain income tax to the government, then if I will ask you that please pay my income tax, you will not be doing that, right? But for example, I am a producer of this particular pen and I am selling this pen. When I am selling this pen to you, now the cost of this pen, suppose 100 rupees, the cost of this pen is 100 rupees, and there is a 10% tax on sale of this particular commodity. So who is selling? I am selling this particular commodity. So who should pay this tax? I should pay this tax. But what will I do? I will sell this product at 110. 100 rupees is the cost of this pen selling price, and I am adding 10% tax so that I should not pay tax, and I will be shifting my burden of tax on the consumer, right? So if I am selling this pen, the burden is on me, but I have shifted my burden by adding taxes, and then I am taking money from the consumer, right? Tax amount from the consumer. So where burden can be shifted, for example, GST, when we are paying school fees or college fee, or when we are purchasing any goods or service for that matter, then burden of tax is shifted from seller to the consumer. This is known as indirect tax. So indirect tax and subsidies, they distort the price of the particular product, right? For example, if a product is there whose factor cost is 100 rupees, ideally this particular product should be sold at 100 rupees. But what happens here, that because of tax, right? Because of tax, suppose there is 20% tax. So what will happen here? I will keep the market price as 120. This is known as what? Market price. So I am keeping market price 120 by adding the tax rate, right? So adding tax amount, I have calculated market price. Now one more thing can be there. For example, this product cost 100 rupees, but since it is a very essential product, pen, suppose, and pen is needed to write, read, etc. So lots of usage in education, and government wants to make education more accessible. So what government has done, government has given 20% subsidy on this. 20% subsidy. When government is giving 20% subsidy, the cost of this particular product will become 80. Market price will become 80. Factor cost is 100. 20 rupees will be compensated by the government, and the market price will be 80. Right? So now what we have understood, there is a market price and there is a factor cost. How do we get market price? How do we get market price? This is what we need to understand. So there is a market price and one is factor cost. If I want to calculate market price was factor cost was 100, market price became 120 by adding tax amount. So what I can write, factor cost plus indirect tax. This is distorting the market price, right? So factor cost plus indirect tax will be market price, or for that matter factor cost minus subsidy, this amount will be deducted, this amount is added, tax amount is added, subsidy amount will be deducted. So 100 minus 20, that means here that is subsidy, right? So this term indirect tax minus subsidy is known as what? Net indirect tax. Net indirect tax. So one thing we have understood, that market price is equal to factor cost plus net indirect tax, right? So two variants of GDP we can calculate. Either we can calculate GDP at factor cost, or we can calculate GDP at market price. So these are the two concepts related to GDP that we should be aware of, right? So this is where we will finish today, and let's meet in the next class. Thank you very much. Take care. Bye bye.